This is Robert from goldsilverpros.com, and I'm here with Dave Kranzler, who spent many years working in various analytic jobs on Wall Street. And for 9 of those years, he traded junk bonds for a large bank. He has an MBA from the University of Chicago with a concentration in accounting and finance. And he currently co-manages a precious metals and mining stock investment fund in Denver, while also running the website Investment Research Dynamics, where he produces 2 newsletters, the Mining Stock Journal and the Short Sellers Journal. Dave, how are you doing today?
I'm doing well, Rob. How are you doing?
I'm doing very well. Thanks for joining me. The markets,
good to be on here.
Yeah, the markets have been pretty much in turmoil for the last couple of months. I wanted to get your opinion on that, and wanted to start with just worldwide money printing and bailouts that we have. I think the tally up to last week, and I know this changes every single day, was $12 trillion by the central banks. And I wanted to get your thoughts on, what is going on there and what effect you think that's going to have on the economy.
Well, I mean, I think the bulk of it is a bailout of the financial system, and a lot of that money is not going to get down to Main Street, and a lot of what they're targeting, a lot of the problems that they're targeting with the money printing and the QE, which is really, it's just really money printing. Those were problems, economic and financial problems that were developing way before anyone ever heard of coronavirus. Mm-hmm. And obviously the Fed saw something bad coming that wasn't coronavirus in September when it started printing money again. At first called it overnight repo, a temporary program, and then it morphed into overnight plus 2 week, and then it got bigger and so forth. So, and the virus crisis forced them just to throw in the towel on any kind of facade. And well, I mean, they're still calling it QE, but let's call it what it is. It's outright money printing. So, and again, it's most of this money. And if you look at the way the programs are structured, it's to address the banking system. These guys don't care about Main Street, about the average household. I'm going to refer to households in the U.S., but it extends globally. I think the problem's more acute here. And so it's, they just needed an excuse to launch. They're not monetary helicopters. They're monetary B-52 bombers. So, and it's going to expand.
Yeah. Do you think they'll be able to pull back without causing a collapse, or do you think the printing will cause a collapse? Meaning, are we in the phase where they're just going to print to infinity and blow up the system, do you think? Or do you think that they're going to try to temper it at some point?
I don't know. I think it depends on, to what extent fires keep flaring up. In terms of whether they can, try to pull money out, reverse the quantitative easing. We saw what happened the first time around they tried to do it. I mean, I think they ended up pulling out about 700 or 800 billion when, on the quantitative tightening. Yeah. And we saw what happened. I mean, the system started to collapse. Mm-hmm. and that's when the repos appeared. And, I saw one of the Fed governors, I don't remember which one, and he was saying, "Oh, well, low interest rates are going to be here for a long time." And I was thinking to myself, is this guy on drugs? We've had low interest rates for 12 years now. So it's idiot. You sound like an idiot when you say, "Oh, we're going to have low rates here for a long time." It's already been over a decade. So, the central banks are backed into a corner. The virus crisis gave them an excuse to try and kick the can down the road. And we'll see if it stabilizes things this time. I mean, beneath the surface, after 2008, life didn't really meaningfully economically get better for the bulk of households. I mean, most of the wealth that was created from the first round of money printing, QEs 1 through 3, most of that was skewed towards the upper 1%. Yeah. And the rest of the households had to take on even more debt just to try and stay in place. So we'll see if this is the one, if we're at the point where they can't fix it with money printing. I know that we'll probably know pretty soon.
Yeah, I know that was a theme of what you and I talked about last year was the wealth disparity between the rich and the poor and also all the debt. So I agree in the last 10 years, consumers have taken on tons of debt to finance their lifestyle and try to maintain that middle class lifestyle. But it's been the top 1% and really the 1/10 of 1%, I think, that's got the bulk of the benefit from the money.
Right. Exactly. That's exactly right.
So what are your thoughts on the virus? And do you think that everybody's going to be back to work in early summer like the administration has continued to say? And if so, or if not, what do you think happens to the economy in the meantime? Do you think the printing is going to work and it's going to stimulate the economy, or what do you see in the next few months?
I mean, in terms of the virus, no one really knows. We don't have enough data, enough history with this virus. I do think that the rate of death statistic is not correct. I think it's highly exaggerated because the only portions of the population that they know are infected are the ones that they can test, and they haven't tested very many.
Right.
I mean, I know a lot of people who had symptoms and went through a flu-like sickness starting in January, including myself.
Mhm.
And I mean, I don't know if I had the virus or not, and certainly a test isn't made available to me right now to see if I did have it. So I would suggest that there's a likelihood that a much higher percentage of the population has been infected, and the death rate is not even close to as high as they're saying it is. But again, it's one of those things where there's not enough data, and we'll know, sometime down the road what the real death rate is from this. So in terms of, when people are going to get to go back to work, et cetera, I have no idea. I mean, I think if they don't let people go back to work, say within the next 4 to 6 weeks, I think it's going to cause a lot more problems than deaths that are caused by COVID-19. I think you're going to start to see a lot of civil unrest. So, I mean, it's a standard economic problem you got on the one hand, and on the other hand, and there's cost and benefit analysis that they're going to have to do, or they're going to have to undergo. So, I think Trump is trying to push to get people back to work as soon as possible, after April 30th. And it sounds like there's plenty of parties in the administration and in DC itself that are resisting that. So I don't know. We'll see.
I want to switch over and talk about the gold market for a minute. Gold physical premiums over the futures is quite a bit. We're about probably 11% if you want to get a 1 ounce bar or coin from retail outlets over the futures market. What's your thought on that? Is COMEX finally broken, or are we just saying overwhelming physical demand and it will return to normal where the futures market determines spot price?
Well, actually, I mean, the futures and the spot are self-reinforcing mechanisms. I mean, when people talk about the spot price, they're referring to the price they see when they pull up Kitco. And that's not the spot price. The spot price of physical gold is established twice a day at the London AM and PM fix. And then everything else keys off of that. So once they fix the price in London, if the banks decide they want to try and push the price lower with paper, they can do that. But physical gold doesn't change hands at those lower prices. So it's a convoluted topic, and the overall market is intentionally opaque. They don't want you to see what's really going on behind the scenes. In my opinion, the COMEX has been showing signs of stress in terms of the amount of physical gold that's available for delivery for a long time. I mean, in the last, 6 to 9 months, the use of exchange for physicals and privately negotiated transactions has mushroomed. And those are transactions that are designed to take the settlement of futures contracts off of the COMEX. Like the AFPs have moved a lot of those settlements over to London, and there's a lot of evidence that suggests a lot of those EFPs are settled in cash at substantial prices above spot. So the signs of stress in the physical market, it's just like signs of economic and financial stress building in the system were occurring way before coronavirus ever appeared on the scene. And then the coronavirus is the catalyst that brought it all to a head. So,
Yeah.
I mean, I think just the fact that the futures price is so far above the Kitco spot price tells you that there's a lot of stress going on in the market. Now, ordinarily, people would say, oh, well, the spot price, people want delivery now, but spot price should be above the futures price. Mm-hmm. And, if there's more people that want delivery than gold available, well, I would suggest that if you take delivery, or if you want physical gold and take delivery of it, you have to pay for it up front. Mm-hmm. And if you think that you're going to have to wait quite some time before you get that physical gold delivered and you can remove it from the vaults either in London or New York, you're not going to put the money up. You're going to buy a future because you don't have to put up as much money and hope that, physical gold appears before that future matures. Mm-hmm. or expires, whatever the formal term is when the drop dead date for a futures contract occurs. So, I think a big part of the spread is that you've got entities that want physical gold. They want to take delivery of physical gold via futures and forwards, but they're not going to put up the money for up front because they're not sure if and when they're going to get deliveries. So, I guess they're starting up on a limited basis some of the refineries in Switzerland. So we'll see if the resumption of some output of gold bars alleviates the spread.
Okay. There's been talk that the 400-ounce LBMA bars are not showing up in COMEX vaults, but they're being used to satisfy COMEX trades. And they're doing it sort of fractional reserve, where instead of 400-ounce increments, they do it in 100-ounce increments, is what I've been reading. Are they double counting the LBMA gold, or what is going on there between the two exchanges? It's really difficult to.
Are they actually those accumulated certificates of equity? Are those? I think that's what they're called. Mm-hmm. Are those actually being used right now? Because if you look at the COMEX vault report for gold, there's not a category for ACE gold in the warehouse report. So have you heard that they're actually being used right now, or is it still in the proposition phase?
It may be in the proposition phase, but I read that they were actually trying to satisfy the demand on COMEX with the LBMA gold.
Well, again, I mean, I don't. Well, there's two things here, and it probably is double counting of the bars, because the way it works is if you're going to accept an ACE certificate for settlement of your COMEX contract when you stand for delivery, the bar stays in London. Mm-hmm. And they're using the excuse, oh, well, we can't transport gold from London to New York because of the virus. So they're, at least for now, if these things are being used or going to be used, the bars are staying in London. Now, again, that leaves you with nothing but a paper claim on gold. So if you want to take delivery of a 100-ounce bar or even a 400-ounce bar, why would you settle for one of these ACE certificates? I know I wouldn't. Yeah. Because you don't really own the gold unless you take delivery of it and get it out of the vault.
Right.
So yeah, it's like I said, there's been several types of paper derivative products that have proliferated on the COMEX. You got I mentioned the EFPs and PNTs. I mean, you've got the pledged gold, which is being used by COMEX banks to satisfy collateral for their performance bonds as clearing members of the COMEX, and those are those are actually warrants on gold bars. And who knows, if the physical gold bar is being used for other purposes as well besides pledged gold or warehouse warrant. So. So this ACE certificate, that's just another paper derivative that they're pasting on to the paper gold system to try and stave off the physical gold crisis that is going on right now.
What do you think would be a catalyst for that that whole scheme, the future scheme, and all of the fractional reserving of gold and the derivatives on gold to end? What some people think that a run on physical or overwhelming physical demand will end that scheme. I'm not so sure. What's your thoughts on
Well, we're starting to see a run on physical right now anyway. I mean, certainly at the retail level, dealers have been cleaned out of bullion. And, you go to any of the big national internet-based dealers and you can buy bullion coins on a pre-order basis. I mean, I wouldn't do that. I would either try to find some on Craigslist or locally so that I can actually take possession of the gold or the silver. I mean, we saw the London gold pool collapse in the late 60s, and that was essentially caused by a run on the Treasury gold, U.S. Treasury gold, because the Treasury gold, per Bretton Woods, was if all Treasury bonds held by foreigners, they could exchange them for gold from Fort Knox. And Charles de Gaulle figured out, he did the math, and he figured out there was more foreign issued Treasury bonds outstanding than there was gold in the vaults. So he started asking for delivery, and it sounds like there are a couple other countries that were going to start asking for settlement of their Treasury bonds in gold, and that's when Nixon had to close the gold window. But the London gold pool collapsed, and what we're seeing now with this paper scheme is the modern equivalent of the London gold pool. And so eventually, you kind of said it yourself, there's going to be a run on physical that the paper claims can't satisfy. And, the paper scheme will collapse. Now, what that'll look like, I don't know. I mean, the COMEX has a force majeure clause in its contracts where it can, and I don't remember, it's been a long time since I read the force majeure clause, so I don't remember what events enable them to declare force majeure, but that's probably what will happen, is they're just going to have to say, look, we're settling all these in cash.
What are your thoughts on the precious metals mining companies? I know some of them have been shuttering their doors. Mexico issued a proclamation that only essential services should stay open and the miners weren't included. So it looks like they'll be shut down at least for a few weeks or a month, perhaps longer. Do you think with gold running like this, but the miners shutting down, that it's going to help or hurt them?
I mean, there's guys that are making the argument that, the producing miners, they're not going to go up because they're not producing anything and they're not getting in revenues. Well, I mean, eventually the mines are going to start back up because, if the virus crisis is at the point where the mines aren't starting back up, that means other major parts of the economy globally are not starting back up, right? So, and some mines are actually starting up again. I know I saw a news report out that New Gold was going to start up production at the Rainy River mine in Canada. So the way I look at it is, I mean, the higher the price of gold goes, the more the gold in the ground is worth. So whether these mines are producing now or producing down the road, they're going to be producing gold and they're going to make a lot of money off it, especially with the cost of energy down where it is. The gross margin spread on gold produced is huge right now because energy is 50% of the cost of production. And similarly, I mean, the juniors, while they need capital to continue advancing their projects, there's been several junior mining financings that have occurred in the last couple of weeks. So I don't know that capital markets are completely shut off to juniors that have good, potentially viable projects. And to the extent that they've got officially declared resource in the ground, as the price of gold goes higher, that resource becomes a lot more valuable. So, I mean, if you just look from today, from 6 a.m. New York time till now, price of gold has gone up $50. So gold in the ground is worth $50 an ounce more now than it was just a few hours ago. And I expect the price of gold to be a lot higher 3 months from now. So, when mine production starts up, these things are going to be veritable cash ATMs.
That's a really good point because when you're talking about the gold in the ground, that's something that they have and don't have to manufacture. So if you're one of these tech companies that you have to constantly produce goods like Apple iPhones, or you're producing whatever piece of technology you're producing, new software, for example, that requires additional labor and additional inputs for everyone you've created. But for the gold mines, they already have the resource in the ground. It's just a matter of getting it out. So that valuation should include also what they have in the ground and then anticipation of what the gold price will be when they start up again. I do, from my opinion, though, I do think that they're going to trade lower, at least for the short term. I was doing an analysis of GDX and the GDXJ, and I think as the profits go down, the prices are going to go down. The trading at lows lower than the Great Recession. But I agree with you. As soon as they start opening up their minds again and start trading again, I think they're going to make tons of money. And I think people invest in them now, they have potential to make a lot of money in the long run. I think everything's really cheap in the mining sector right now, it seems like. I didn't know if that was your opinion or.
Very cheap. Everything's very cheap right now in the mining sector. And I don't think it's going to get a lot cheaper. Because the mining stocks are going to, especially, you're referring to the GDX. I mean, those are companies that produce or will be producing once they can resume their operations. And the market, theoretically, is a forward discounting mechanism. So I think the market understands that these things aren't going to be shuttered forever. So, and there's countries that mining is a significant part of their GDP, Mexico, for instance. Mm-hmm. So they're not going to be able to leave their mines closed for too much longer without inflicting, avoidable economic damage on their systems.
So Dave, if you'll explain how people can get in touch with you. I know that you run two newsletters, the Mining Stock Journal and the Short Sellers Journal. How would people go about subscribing to those?
Sure. My website is investmentresearchdynamics.com, and on the front page there's links to both my Mining Stock Journal and Short Sellers Journal that kind of describe how they work. There's no minimum subscription time requirement beyond the first month. So if you try it out and you don't like it, you can cancel it after a month and email me and be happy to cancel it for you.
Well, Dave, as always, it's been a pleasure. I thank you for joining us on the program. Look forward to speaking to you again.
Likewise, Rob. Thanks for having me on again. I enjoyed it.